a new concept that's come up that has received not too much publicity in the industry media, referring to the total superannuation balance, and some other updates as to technical material that we're still waiting on or changes that have occurred. The first issue I want to cover across, there are a whole series of issues to do with treatment of death benefit pensions, death benefits in general, and changes to the systems. And in particular, looking at some regulations which have been promulgated prior to 1 July 2017 and will end up having quite an impact with respect to how certain death benefits are going to be treated. Cherie, if you could move to slide 2, that'd be great. So just to cover across some of the basics, simply that death is a compulsory cashing event and the monies must be removed from the member's balance to provide some sort of superannuation benefit to the beneficiaries as soon as practicable. Interestingly, death is a condition of release with a nil cashing restriction. Unfortunately, in the regulations, the term cashed is not defined, and therefore we generally take the ordinary dictionarial meaning of the word, and the concept as soon as practical is also not defined. Generally though, it's assumed that the death benefits must be cashed within 6 months of the date of death. In some cases, trustees have tried to prolong that 6-month period, particularly if they're waiting for, say, the property market to improve in order to sell a property and to pay the death benefits, etc., etc. That's not necessarily congruent with the regulations, and the trustee may get certain questions asked. But at the moment, it's generally assumed to be within 6 months of the date of death. The regulations further clarify in what manner death benefits can be cashed. Normally we just assume cashed, okay, well that's being taken out of the superannuation environment, but in fact Regulation 6.21 allows for one or more lump sums, one or more annuities, or one or more pensions. The one or more lump sums is actually quite an interesting one for the simple reason that we see the capacity to be able to pay out an interim lump sum and a final lump sum to certain beneficiaries. It tends to be slightly abused. Generally, if you're paying out an interim lump sum, it's because there's some form of illiquid asset or unrealisable asset sitting within the superannuation fund that can't be realised in time, and you therefore have the capacity to be able to defer the final payment. Interestingly, with all the rules that are happening, the introduction of those rules, there's actually no changes being made to the range of beneficiaries to whom the death benefits can be paid. Now, interestingly, one of the changes is that the death benefit that is cashed as one or more pensions or annuities must be a superannuation income stream that is in the retirement phase. That's actually quite an important one, as we'll come to a little bit later. Cherie, if you could move forward, thanks. Now I've put on the slide a definition direct from the explanatory memorandum as to what is a superannuation income stream in the retirement phase. Interestingly, they're taking into account income streams which are deferred income streams. Now, we used to see these commonly quite some years ago, less commonly now, of course, but with some of the new innovative income stream proposals that are being considered and yet to be legislated, it's quite possible that a death benefit could be a deferred income stream in the future. It will, of course, be still considered to be in the retirement phase, notwithstanding that the payment period is deferred. Interestingly, the changes have all taken into consideration the terminal medical condition of release, and none of the conditions really change with respect to that particular condition of release. Now, again, just a reminder that going forward, a TRIS is not an income stream that's in the retirement phase. Interestingly, they've also included non-commutable allocated annuities or non-commutable allocated pensions. These are income streams, again, which date back quite some time. Interestingly, this is a point that hasn't been covered off terribly well in some of the industry media, that of course, if an income stream which is or has been in the retirement phase and has been counted against an individual's personal balance transfer cap, if a commutation authority in respect of that transfer balance cap hasn't been complied with, technically for tax purposes, that superannuation income stream ceases from the beginning of the year in which the commutation authority hasn't been complied with. That may not be the same year as when the problem occurred, but from when the commutation authority hasn't been complied with. Interestingly, if you have a couple of ticks against you with respect to these commutation authorities, the income stream ceases to be a retirement phase income stream for the life of that income stream. So that's just not the year in which the commutation authority hasn't been complied with, it's all future years as well. It's a particular point to watch out for. Sharif, you can move forward, thanks. Now, technically, when a death benefit is to be paid on or after 1 July 2017, a credit will arise to the transfer balance account of the individual beneficiary at a particular point in time. Now, interestingly, the Income Tax Assessment Act has been changed so that the reversionary pension counts as a credit to the reversionary beneficiary's transfer balance account. Strictly speaking, of course, the individual's transfer balance account will cease at death. And it's interesting just to look at the issues with child pensions, which we'll come to in a moment. And what they've made it very clear is that the transfer balance account of the deceased doesn't carry across to the surviving spouse or the surviving beneficiary. Now, we've previously covered across some of the counting rules and the balance rules with respect to the counting of death benefits. Where it's a reversionary death benefit, and they have clarified a number of issues to determine precisely what is a reversionary death benefit, basically you can assume that if the trustee has any discretion with respect to the payment of a death benefit, it is not a reversionary benefit. A reversionary death benefit must have no discretion exercised by the trustee, provided of course that the reversionary nomination is not invalidated. So what we look at here is that if the deceased member died before 1 July 2017 and the pension automatically reverted, the credit occurs on the later of 1 July 2017 or at the end of the period of 12 months from the day the pension first became payable. Now, that definition is quite interesting because it clearly captures deceased members who have died prior to that 1 July 2017. Interestingly, there's a couple of things that have been hidden in the amending Act, which has looked at the changes that are implementing various changes to the SIS Act, to the Income Tax Assessment Act and the Income Tax Assessment Regulations with respect to this. And in fact, what they are now looking at are pensions that have automatically reverted, dating back to the reversion happening from 1 July 2007. It's a considerable change and will have a significant impact on how we're able to treat reversionary death benefits and death benefits in general that are being paid as a pension. If you can move on, thanks, Sheree. So the credit that arises to the transfer balance account is equal to the value of the superannuation interest that supports the death benefit income stream. And we're looking at really two countings here. For those death benefit income streams which commenced before 1 July, we're looking at the value just before 1 July. And again, they've clarified that. They're really meaning at about a minute to midnight on that date. And we're also looking at the issues of when a death benefit income stream commences on or after 1 July, the value on that starting day. That's an interesting one. Now, they're valuation issues. This is not when they're actually going to be counted, but the valuations. If we have a look at the draft LCG document, the transfer balance credit is equal to the value of the superannuation interest that supports the reversionary pension and not, and I emphasise the not, the value of the superannuation interest when the transfer balance credit arises. Now, we've previously spoken about this particular issue because it means that any investment earnings between the point of the deceased beneficiary taking over the reversionary pension and when it's actually counted for cap purposes, they're not counted. We also had a look at a situation where an insurance policy was paid out on the life of the deceased member, and we've assumed here that the premiums for that life policy have been solely paid from the pension account. No other account, not the accumulation account that might have existed in respect of the individual. The premiums have been paid solely from the pension account. There was a view, and there's still being a view espoused, that this might be an unintended consequence. In other words, Treasury and the ATO completely missed this particular implication. Now, interestingly, the draft LCG document has yet to be finalised, and it's one of the ones that's taken the longest to finalise, and we still haven't yet seen that. So watch this space. It might be an interesting one to see whether that particular issue is covered across when the finalised version of the Law Companion Guideline is eventually released. Now, one of the interesting issues with respect to the payment of life benefits is that the document actually does make a clear distinction between life insurance benefits that is paid to a reversionary pension account by omission and an elected death benefit pension account. In other words, one that does not specifically revert to a death benefit beneficiary, but who elects to take the death benefit as a pension somewhere down the track. In that case, the LCG document clearly makes the distinction between the two and definitely includes the life insurance payment in respect of the elected death benefit pension, but not in respect of the reversionary pension. So I would strongly suggest that we watch this space because I think there will be further clarification coming out. If we consider this from a practical perspective, it could be that, for instance, someone may pass away with a benefit of $400,000 sitting in their superannuation, which would be converted into a death benefit at some particular stage if there's no reversionary nomination. Let's assume that there might be $1 million life policy on the life of the member held by the trustee. Interestingly, the counting would be substantially different, and it'll remain to be seen whether the ATO does clarify this in the finalised document. I would anticipate that we'll be releasing further issues and updates as legislation and strategies are evolving prior to the end of the income year. So watch this space and see what's going to be happening. Cherie, if we could move forward. Now, we look at the timing of the credit with respect to a non-reversionary death benefit, in other words, the pension benefit that has been elected to be taken. And so what we're looking at it is the counting either from 1 July 2017 in the case of a deceased member dying before that date, or from the day the pension first becomes payable. So it's an important distinction between a reversionary benefit and a death benefit that has been elected to be taken as a pension. And of course, in that particular case, we don't necessarily have a minimum pension payment obligation in the income year in which the deceased member died. So you could be in a situation there where there is no minimum benefit that is required to be paid under law, and you could also have investment earnings increasing the amount of the deceased member's interests between the date of death and between the date of death and when the death benefit income stream is elected to be taken. And of course there, we're also looking at this issue of the payment of a life insurance policy proceeds held by the trustee in respect of the member. Those distinctions clearly need to be made, and it also gives us significant cause for consideration as to whether we should be talking to clients that virtually all pensions should be reversionary and subject to the trust deed of a superannuation fund, how we can actually go about making that nomination. And in the case of a self-managed fund, the interesting conundrum is whether a reversionary nomination supersedes a binding death benefit nomination or whether the BDBN actually has precedence. It's an interesting legal issue which hasn't really been clarified up until this point in time. So the strategy that I undertake with respect to clients is that we have a binding death benefit nomination held in respect of the member, which clarifies that in the first instance the income stream is to be paid as a reversionary beneficiary, and then we tier the nominations so that if it subsequently transpires that the reversionary beneficiary predeceases the original pensioner, for example, or is otherwise invalidated, we have a second tier that allows the money to be paid to other beneficiaries or to the member's estate. Of course, not every retail fund will allow that to happen. So that, again, gets a bit interesting. Now, there have been some significant changes to the way death benefit treatments can be handled from henceforth. Cherie, if you could flip forward, thanks. In the past, we have not been able to roll over death benefit pensions from one superannuation fund to another. Now, I'll come to some issues in a moment, but that's an important one to consider, that death benefits, as defined under the legislation, could not be rolled over. There was one small instance, you could roll it over for the purposes of immediate cashing out of the superannuation environment. It could be that there was a problem with one provider and there was some allowance for that. Now, what it does do, the changes to the legislation allows you now to move a death benefit pension to another fund, and it could be that that fund better suits that individual's needs with respect to the administration of the death benefit. But again, the important consideration is that a death benefit will always remain a death benefit. Now, one of the consequences of the amending act that's gone through recently is that the prescribed period for death benefit commutations being treated as superannuation death benefits has been repealed. Now, it hasn't been repealed as of 1 July 2017. That amending act has repealed that particular issue, and we are now effectively under the new rules. This is a big and quite important benefit issue that needs to be considered prior to 30 June 2017. This was a bit of a surprise. No one anticipated that the government would appeal the relevant areas of the Tax Act on the date of promulgation. Everybody expected it to happen as of 1 July 2017. So functionally, what's going to happen is that all benefit withdrawals stemming from a death benefit income stream will be a death benefit no matter when the withdrawal is made. Formerly, we had a section of the Income Tax Assessment Act, section 307-5, which allowed us for a period of 6 months after the date of death or 3 months after the date of probate, whichever was the latter, we could actually commute an income stream back to the accumulation phase and do a number of transactions with that, and it effectively lost its death benefit status. That is now no longer the case, and as I will continue to emphasise, this is now a current issue, not an issue which commences on 1 July. Now, what we have done in the past is once we've been outside the relevant period, that section 307-5 has allowed us to be able to convert what was a superannuation death benefit to a member benefit, a superannuation member benefit. The distinction is actually quite important because, of course, a superannuation member benefit can be aggregated with other accumulation benefits, for example, that the member may hold, and could be rolled over to another fund. That no longer can happen. So it begs the question, what can we take, what actions can be undertaken if we have an account-based pension which had already reverted or taken as a death benefit income stream and was taken. And interestingly, this can be dated back to 1 July 2007. So there are significant implications for death benefit income streams which are currently in place. The reality is that we now cannot use those relevant sections in the Income Tax Assessment Act because they just don't exist any longer. They have been repealed. My current copy of the legislation, which was printed in early February, does not include those particular provisions. So we are having to work under the new system, notwithstanding that most provisions will not apply until 1 July this year. It's a bit like Baldrick's cunning plan. No one anticipated this, and what it has done, it's basically stopped the aggregation of certain death benefit income streams that have been in place for a while with other member benefits for aggregation in a new fund, for example. So there's a couple of technical issues which I have yet to see clarified. Technically, of course, within a self-managed fund, for example, you may have a series of sub-accumulation accounts which are held in respect of a particular member. It could be that non-concessional contributions have gone into one sub-account. It could be that superannuation guarantee and salary sacrifice contributions have gone into a second contribution sub-account in respect of that member. For the legislation, for legislative purposes, those accounts are actually aggregated. You have one superannuation accumulation interest in that fund, notwithstanding you've got a number of sub-accounts. That legislation, I would assume, is going to have to be amended because technically, if you roll over an income stream, we know we can't roll over income streams, so the death benefit income stream will need to be commuted, rolled over. It's in the accumulation phase, but you must start another death benefit income stream basically upon receipt. Technically though, it's in accumulation phase until you commence that pension. So I think there's going to need to be some technical amendments to this concept of what is a superannuation interest with respect to the accumulation benefits. As I say, this has been a surprise and will also impact strategies that people are going to be able to consider with respect to the treatment of the death benefit income streams going forward. But just a word of caution, we are now under the new rules with respect to this. So if you are considering prior to 30 June trying to commute a pension, aggregate it with other member benefits and carry it forward, that cannot be done. It'll be interesting to see whether the finalised law companion guideline will actually give us any further clarification on this and whether the government will have looked at it and said, well, this is an unintended consequence of our actions and will allow you up until 30 June to undertake actions that would previously have been permissible. Watch this space. Cherie, if we can move forward. Now, one of the issues that's also arisen with respect to the payment of some of the death benefits, where you've had a reversionary benefit paid in the form of a capped defined benefit income stream, and this could be, for example, something from the Commutable or CSS or PSS scheme, although there may be a 12-month delay in the credit arising in the beneficiary's transfer account, the income tax consequences of the receipt of that benefit don't actually change. So in respect of the reversionary benefit, if the individual, the beneficiary, receives that defined benefit income stream and already has, for example, another capped defined benefit income stream, and if they then exceed the defined benefit income cap, which in the initial period is $100,000, in that first 12 months before the counting occurs, the beneficiary will have to take on the income tax consequences of that additional income that's being paid. Now, of course, one of the things that we haven't seen too much of recently are where death benefits have been paid to children. And of course, for those old enough to remember, in the good old days prior to the changes in 2007, it wasn't necessarily uncommon to see a reversionary nomination being put in place to an adult child so that an allocated pension could be paid across to that adult child at the death of the primary pensioner. That got knocked on the head, of course, with the changes that happened in 2007, 10 years ago under the Howard and Costello regime. And so what we saw was the capacity to pay a death benefit in the form of an income stream to a child reduced to minor children under the age of 18 years of age, or where the child is financially dependent, or where there's been a disability described by the Disability Services Act. Now, of course, if you pay a death benefit to a child under the age of 18 or financially dependent under 25, in general, that death benefit must be cashed at the age of 25. It cannot be continued as an income stream. The exception to that rule, of course, is where the disability qualifies under the Disability Services Act definitions, and you can continue that income stream for the life of the beneficiary. And of course, for cap purposes, what's going to happen is that the death benefit pension, if it is paid to a child beneficiary, will have the pension counted toward a modified transfer balance cap. And of course, what happens at the age of 25 when we assume that the pension ceases? The transfer balance account is reset so that the individual in receipt of that death benefit pension is able to qualify for their own transfer balance account when they retire. Going forward, if you could please, Cherie. Okay, so a child receiving the superannuation death benefit income stream will have their modified transfer balance cap linked to the deceased parent's cap, and this is when it starts to get quite interesting with respect to counting. If the child is currently receiving that superannuation income stream, the child's transfer balance cap at 1 July will be 1.6 million. If the deceased parent didn't have a transfer balance account, in other words, they were in the accumulation phase and hadn't yet established a pension that qualified for the retirement phase qualification, and they die after 1 July, the child gets a proportionate share of the deceased's superannuation interests multiplied by the $1.6 million transfer balance cap. Interesting one. If the deceased person died having an existing transfer balance account, in other words, they had a pension which had qualified for counting, then we use an adjusted calculation and we look at it on a proportionate basis given the number of beneficiaries, child beneficiaries, to whom that income stream may be paid. Sure, if we can move forward. This creates a number of issues with respect to particular scenarios where we've got potentially significant values of insurance held within a superannuation fund or by the trustee in respect of a member. So let's look at this particular scenario where we've got Pierre, who's a single parent with 2 minor children, and the value of his superannuation benefit is currently $400,000. But as a high income earner with a number of debts, he's determined that he has a policy being held by the trustee of $2 million. Pierre previously put in place a binding death benefit nomination in favour of his children in equal shares. So that, of course, if Pierre died, his total superannuation death benefit will be paid to each of the children. We've got a $2.4 million pot after the payment of the life insurance. Therefore, each child is due $1.2 million under the terms of his binding death benefit nomination. Prior to 1 July, each child could have received half of that amount, so the $1.2 million, as a death benefit pension. From 1 July, each of those children will be limited to a death benefit pension of $800,000, half of the 1.6 cap, and it begs the question as to what the remaining $400,000 has to, the treatment of that particular amount has to be. So when we start looking at the legislation, it's quite clear that that excess amount of $400,000 must leave the superannuation system as a lump sum payment. Now, given the fact that Pierre held that amount of life cover within his superannuation fund, one would hazard a guess that these would be unintended consequences of the actions that Pierre has taken. So it could be that we now need to review levels of cover within superannuation policies to determine whether it would be better to have certain levels of cover outside the superannuation fund to avoid issues of precisely how these death benefit income streams can be treated for child purposes. It's going to be an interesting one because I think it does have some significant ramifications where you have got members that have got significant values in life insurance policies that were due to be paid out on death. So let's leave the death benefit issues for the moment. It's a catchy one because unfortunately we don't see too many of the death benefit issues. We don't particularly want to have to deal with those too commonly anyway, but because of the changes in the rules, there are now many more technical issues that need to be covered off when we're looking at death benefit situations. Let's move forward to the transition to retirement rules. So Sheree, if you could flick forward. As we've previously discussed, the government is changing the transition to retirement rules, the TRIS pensions, to basically stop the arbitrage between the tax rate, the individual tax rate of the individual and the tax rate of contributions to superannuation and the earnings on superannuation assets subject to the TRIS treatment. And again, let's emphasise that a transition to retirement income stream is not a retirement income stream or pension for the purposes of the $1.6 million transfer balance cap. The 15% earnings tax rate on assessable income of the pension assets will continue to apply. These transition to retirement income streams, as I've said before, I think will continue. They may be slightly less attractive than previously, but there are a number of benefits in respect of being able to apply the proportioning rules and to isolate certain tax components subject to the timing of the commencement of the TRIS. So where I'm looking at here is where you've got a TRIS that, let's say, is already commenced, and it has a substantially high tax-free component. The proportioning rule makes it very beneficial to retain it in that income stream phase so that we get the benefit of having a strict proportion and a potential increase in the value of the tax-free component over time subject to the investment performance of the TRIS. Equally, if an individual is able to make a contribution of non-concessional contributions up to $540,000 in the current income year, they could immediately convert that non-concessional contribution to a TRIS prior to 30 June, and you've effectively isolated that the tax-free component that is created by that contribution. Now, you'd also have to consider again the issue of what is a superannuation interest, and it could be that you need to convert existing accumulation funds to a temporary TRIS to be able to separate out the non-concessional contribution that's being made prior to 30 June. The issue that you would then have to consider is, well, what do you do with that temporary TRIS, which is the accumulation benefit that pre-existed after 1 July 2017? And just be aware, of course, that the ATO is looking at issues where, for CGT transitional relief purposes, a TRIS has been put in place solely for the purposes of being able to apply the CGT relief and then is subsequently commuted early after the new income year. Just a word of warning on that particular one. But personally, I think the TRIS strategies will continue to be important because you can add significant value through proportioning and isolation of tax components. Now, let's move forward. Thanks, Cherie. Now, it's important that the issues that we discussed previously with respect to the CGT transitional relief and the uncertainty that existed with respect to the capacity to be able to apply the relief under certain circumstances. Now, the finalised Law Companion Guideline, which was released a couple of weeks ago, confirmed that we don't have to commute a TRIS on the 30th of June in order to apply the CGT relief. Now, that is on the basis, of course, that if in a self-managed fund, the fund used the proportionate method of calculation in the pre-commencement period. In other words, it was an unsegregated fund, and you had a mixture, therefore, of pension assets and accumulation accounts. And of course, the other proviso is that all other qualifying conditions are met. The only issue that we don't really have clarification on with respect to the application of CGT transitional relief is the issue of a TRIS being the sole account of a self-managed superannuation fund. By default, that account is therefore 100% segregated, and they would generally be expected to use the segregated approach for CGT relief. Now, the segregated approach would require a different set of conditions, and you may need to look at a circumstance if that applies, and to be honest, I don't think there'll be terribly many out there where this does apply, where you may need to deliberately unsegregate by doing a small commutation or undertaking some action in order to remove the segregated approach with respect to the CGT transitional relief. Next slide, thanks, Cherie. And again, one of the issues that's currently being discussed in some depth is exactly when does a TRIS stop being a TRIS, and do you in fact have to commute a TRIS and commence a new account-based pension upon satisfaction of a full condition of release with a nil cashing restriction? This has always been a slightly contentious issue, and my view's always been that a TRIS satisfies a condition of release and it is a full account-based pension subject to significant restrictions. First of all, of course, that a TRIS can only have a maximum of 10% income paid out in an income year, and if you commute a TRIS to a lump sum, you cannot remove that lump sum from the superannuation environment until such time as you meet the appropriate condition of release that would actually allow that. There's been a couple of abuses of the 10% rule, because technically there's no apportionment of the 10% rule. So you could, for instance, commence a TRIS on 1 July, commute it on the 31st of December, start a new TRIS on the 1st of January, and you would actually be able to take out 20% of the account value of the TRIS, as I say, because the 10% has not been proportioned across the period of time that the TRIS operated. So what the government has said is that they realise that this is a particular issue, and they're going to clarify through a legislative change that you will not have to cease a TRIS in order to have the TRIS conditions removed from that particular income stream. And if and when these are enacted, that it'll stop the questions arising as to whether a TRIS will always be a TRIS subject to the removal of those conditions of release and any restrictions. It'll also then clarify whether that income stream will be counted towards the pension balance transfer cap for that particular individual. And according to Kelly O'Dwyer, we expect to see the legislation amending these particular issues in the winter sittings so that we get the amending legislation promulgated by 1 July 2017. It's an interesting conundrum because technically the regulations consider the movement of benefits between categories of preservation through the satisfaction of condition of release. And in a couple of cases, these are automatic movements from preserved to unrestricted non-preserved. When we're looking at, say, the satisfaction of retirement after the age of 60 with the cessation of an employment relationship or the attaining of age 65. These are automatic movements of preserved to unrestricted non-preserved or restricted non-preserved to unrestricted non-preserved. The regulations are quite clear with respect to the automatic movement. Unlike where you elect to apply the retirement condition of release, under which you make a declaration that you have no further intention of working either part-time or full-time for the foreseeable future. Now, of course, in respect of a self-managed fund and any of the retail funds, you need to look at the trust deed provisions to determine what documentary evidence may need to be held in order to support not just the movement of preservation components, but the fact that a TRIS will be converted to a full account-based pension. So once again, this will be something that we'll update as the legislation is promulgated. Cherie, if you could move forward, thanks. Now, one of the interesting things that's come across now is this concept of the total superannuation balance. Now, regrettably, it's one of those issues that has not been commented upon much in the industry press, and from my perspective, a lot of the implications haven't been adequately discussed. But this is going to have a significant impact on a number of issues with respect to your client affairs. Now, technically, the total superannuation balance counting will limit your capacity to make contributions to super on a non-concessional basis once you've reached or exceeded the relevant threshold. Interestingly, the ATO reckon they'll be able to provide information to individuals from March 2017. I looked at that one, I thought, let's wait and see precisely how that is worked in practice. If we can go forward, thanks, Cherie. So as I say, the total superannuation will balance will have an impact on your eligibility to make non-concessional contributions or use the bring forward rule. Interestingly, it'll also have an impact on the eligibility to use the concessional contribution catch-up provisions, which of course only start in 1 July 2018. It also has an impact on the entitlement to the government co-contribution and the spouse superannuation contribution tax offset. Importantly, if we have a look at the non-concessional contributions, we understand that when the total superannuation balance exceeds 1.6 million, then that's it. We cannot make particular contributions, and we've lost the eligibility for the concessional contribution catch-up, which of course is tagged at $500,000, not 1.6. Interestingly, this legislation does not include any provision for the indexation of the $500,000 threshold for concessional contribution catch-up purposes. Thanks, Cherie. If we can move forward. So again, the Law Companion Guideline confirms that a total superannuation balance is also subject to transitional arrangements. The counting of this starts to become interesting, and if you have a look at some of the definitions I've put down there, you start to think, well, actually what is and what is counted towards the concept of the total superannuation balance. So, Cherie, if we can move forward. I've given you a couple of examples there where we're looking at issues to do with the government co-contribution and the spouse tax offset where certain conditions are not met or are met. I'll leave that one because there won't be too many impacts on a day-to-day basis with respect to that. So if we look at the concept of the total superannuation balance on the next slide, we're looking at the accumulation phase superannuation interests, and the accumulation phase also includes deferred superannuation income streams and transition to retirement pensions. Now, the deferred superannuation income streams really refers to certain income streams that may be established in the future, but where the payment phase has yet to commence. Now, interestingly, there's a couple of issues to do with certain CSS and PSS type pensions, where an individual has met a condition of release and yet deferred access to their pension entitlement. So we look at certain things with respect to the transfer balance account and look at the value of income streams that have already commenced or commenced from 1 July 2017. And we looked at the modifications with respect to those income streams. So of course an income stream, the counting towards the transfer balance account, is at the commencement of the income stream or 1 July 2017 or just before 1 July 2017. So clearly we need to look at a range of issues as to what we need to take into consideration with respect to this concept of total superannuation balance. Interestingly, of course, with respect to the cap, you disregard any amounts that have been attributable to personal injury contributions and any payment splits made under the Family Law Act. It also tracks rollovers in transit between superannuation funds. Of course, begs the question, how does the ATO actually know about these and what's going to be the reporting requirements from the superannuation fund perspective? So the first part of this is that we look at what's in the accumulation phase. And that's going to be relatively easy to count for the majority of superannuants. We're going to be able to see that on a day-to-day basis. Now, interestingly, if we have a look at what's actually counted in the retirement phase, we're looking at market-linked income streams. So quite differently to the counting that occurs for the purpose of the transfer balance account, which we considered in a previous webinar, what we're actually looking at here is the asset balance. So interestingly, if we had a situation that we previously considered where there was a premium attached to the counting of a market-linked income stream for transfer balance values, that premium will be ignored for the purposes of calculation of the total superannuation balance. So we come back to the value of the assets. Now that, in my mind, is far more realistic than undertaking the value that was taken into account for the transfer balance account. Thanks, Sheree. If we can move forward. And of course, we come to the defined benefit lifetime pensions that have already commenced. And again, for the purposes of the the total superannuation balance, their balances will be counted as 16 times the annual entitlement. Now, interestingly here, the defined benefit lifetime pensions triggered but deferred, again, will have their balance counted at 16 times the annual entitlement. It then begs the question that if you have a defined benefit entitlement in the accumulation phase, what's the value that's actually going to be taken into account? And here we have a big conundrum because the regulations don't actually provide a precise method of determining that value. If there is a methodology applied in the accumulation phase under the trust deed of a particular fund, then we can apply that value. And then they look at, well, what happens if we can't? It says otherwise, the total amount of the superannuation benefit that would become payable if the individual voluntarily caused the interest to cease at that time. Well, what does that mean? Well, we don't actually know. There's no clarification on that as yet. Interestingly, there was an MLC technical services document that came out the other day that looked at for certain defined benefit interests where the only entitlement would be in the form of a pension. They believe that the value will be zero or minimal for the purposes of the total superannuation balance purposes. Now, I spoke to CommSuper with respect to this particular issue, and at this stage, for example, they don't know themselves precisely how things are going to be treated, and they are waiting on advice from Treasury as to exactly what they need to advise their members. For those advisors who deal with CSS and PSS, I'm advised that there'll be a fact sheet coming onto the website at some stage as soon as they've got clarification. But I'd equally appreciate it if you do hear of the methodology that's going to be taken into account for TSB purposes, if you could let me know about that one. That would be very handy indeed. Going forward, there's a couple of issues that you now need to consider with respect to, well, what happens if you can't make a non-concessional contribution because your total superannuation balance exceeds the $1.6 million limit? Now, unfortunately, we've still got superannuation fund members out there who have self-managed superannuation funds who, bless their little socks, continue to pay for fund expenses out of their personal cheque account or on their credit card. In the past, one of the more common methodologies has been to be able to treat those expenses as effectively a non-concessional contribution. And if you go back to the tax ruling, what is a contribution, you get some definition about the treatment of non-concessional contributions or counting toward the non-concessional contribution cap under that particular tax ruling. There's really now no wriggle room with respect to this. We cannot treat it as a non-concessional contribution. And technically, if there's no other solution, you may need to book that payment by the member from their personal account as a borrowing. And technically, again, that would be breaching Section 67 of the SIS Act. So another thing to be careful of going forward. Cherie, if we could flip forward. We're still awaiting a significant number of updates, legislation to be promulgated, and regulations and amending acts. So some of the things that have been recently clarified, we referred to the capacity, rather perversely, of the Law Companion Guideline draft format, allowing a limited commutation of certain legacy pensions that would be able to be partially commuted for the purposes of the transfer balance cap. The finalised regulations make it clear that that will not happen. That was someone's pie in the sky idea, but now will not happen. And again, one of the issues that's been discussed in respect of self-managed superannuation funds with respect to all of the superannuation reforms was the capacity not to have to obtain an actuarial certificate in circumstances where the fund runs an unsegregated fund. And again, the regulations retain the status quo on that. You will need to have an actuarial certificate if you have an unsegregated fund. There have been a couple of recent issues that have arisen with respect to limited recourse borrowing arrangements and how the government is proposing to make amendments that will take into account the outstanding balance of an LRBA towards a member's annual total superannuation balance counting. Precisely how they're going to do this, we're not too sure. It's caused a fair degree of mayhem in the industry, and it would appear that the concern from the government and Treasury is really of a very limited basis, where an individual, for example, has withdrawn monies from the superannuation environment in order to loan to a family trust, for example, which will then subsequently loan the monies back to a superannuation fund in order to provide the funding for an LRBA. Where you've looked at circumstances such as this in the past, quite a number of these were done in the early days with 0% interest rates between the family trust and the superannuation fund. And there have been a number of private binding rulings looking at issues as to whether the 0% interest rate created a problem and whether that was a de facto contribution. And in the early days, the ATO said, no, that's not a case where we need to be concerned. They are clearly trying to cut back on the treatment of LRBAs, or the concessional favourable treatment of LRBAs, and it'll be interesting to see what the amendments are and how they're going to end up treating those. So again, watch this space. If we can go forward, thanks, Cherie. And again, we're still awaiting a number of things with respect to death benefits. It's been a long time coming. Those comments, as I say, were due back to Treasury by the 10th of March. Normally we would see something coming out, and it would give me some cause for concern that we haven't yet seen the finalised document. I would suggest from the comments that I know have been sent back to Treasury that there have been some issues that the government hasn't considered, hence the delay in receiving that. But the treatment of death benefits is going to be very important going forward, and again, watch this space. We are still yet to see the finalised LCG document with respect to defined benefit income streams. That's not going to apply to too many people, but again, it'll be an interesting one going forward. That's it for the webinar today. There's a fair bit of material in there. Unfortunately, this is an area that's going to be subject to change going forward, and so I would expect that we may well have a further webinar closer to 30th of June, and at least some update documents that are going to come out. If you've got any questions, I'm cognizant of the time here that we're running close to the cessation time. I would suggest, if you would like, to send me those comments by email, or those questions by email, and I'd be happy to clarify anything that I can. Thanks a lot, Ryan and Cherie. That's it from me.
Thanks, Neil.
Thanks, Neil. It's very good.
Not a problem.